Over the last few years, I've been fortunate enough to build up a double-digit property portfolio. And it's during this period that I've had to develop my own knowledge and navigate through a whole host of challenges and mistakes. But the reality is, if I can do it, then so can you. This Property Market Investor Real Investor Success Series has been created so that everyday Australian investors can share their investing stories to the benefit of those looking to grow their own knowledge. Today, I'll be meeting with Lloyd Edge, who has built up a 16 property portfolio since his humble beginnings as a music teacher in Sydney. Lloyd's story is really one of, if he can do it, then so can I. Lloyd's journey has allowed him the lifestyle he always dreamt of, which includes now living in his waterfront property in Cronulla, Sydney, with his wife and newborn son. Let's join Lloyd and find out more about his inspirational investing story. Hey Lloyd, how's it going?
Good, Ryan. How's things?
Yeah, pretty good, thank you, mate. So let's go right back to the beginning. What was it that actually got you started in property?
Well, interesting story there. The first property I bought was actually not an investment property. So I actually bought a home to live in. So I'd been renting for a few years and I thought, okay, I really want to get in and just find somewhere to live. So that's when I actually bought an apartment, brand new apartment, and that was over at Rockdale in Sydney.
So was that an off-the-plan apartment?
It wasn't off the plan, but the building had been constructed, and then there was still some properties sort of for sale there. So I don't think the developer was in such a rush to sort of sell them off the plan at the time. Yeah. Market was a bit slow at the time.
What year was that?
That was in 2003.
2003, okay.
And so I bought that, but with the intention that I knew that, although at the time I didn't think I was going to be a big property investor, I knew I would have some investments in the future. Yeah. So I bought that with the intent that I would be able to rent it out in the future. So, it was near the station, it was near the water down at Brighton and Sands. So I knew that it had good investment potential. Yeah. So that was basically my first property. But in terms of investing, it was probably about 4 years after that I decided that I really want to start building up some investment properties, and that's when I decided I'd buy another property, and then I moved into the next property and then rented out my Rockdale unit. I see. And that's actually started it.
So what was the purchase price for the Rockdale new property at the time?
Yeah, so it was $260,000 at the time.
Definitely 2003 prices.
Definitely not today's market. Yes.
So it was it 4 years after that you purchased the next one?
That's correct, yes.
Yeah, 4 years. And during that time, did you achieve growth with the Rockdale property?
I didn't achieve much growth at all at that time. A couple of reasons for that. And of course, when I bought, apart from the fact that I was buying a home, I also didn't know much about property at the time. Yeah, indeed. So I bought, obviously without any kind of a strategy in place, but also bought at the wrong time in the cycle. We just had the boom of the Sydney Olympics, and that had all ended. So the prices had really sort of gone through the roof, and they were just coming back down. But I wasn't really, I didn't know anything about that, so I just sort of bought the property. But what that meant was over the next few years, there was actually through 2004, 2005, there was a slight decline in Sydney prices. So I actually didn't get any growth for probably for about 3 or 4 years.
Did you sit on negative equity at that stage?
So I was sitting on, I wouldn't say negative equity because I did put in a 20% deposit. But I was sitting on, it probably went down to about a 10% equity. So it was negative to what I put into it. So from a bank's perspective, it was probably still fairly good because I did have some equity, but only equity that I've put in.
So we could potentially even relate that scenario. So 2003, you purchased your first property in Sydney. We could almost relate that to today, right? 2019, purchasing a property in Sydney. And let's just fast forward. We'll go back through the journey from where we're up to, but let's fast forward 16 years. What's your portfolio size?
So I've got 16 properties. The value is about 12 million at the moment, and it's sitting on about a 50% LVR. So I've got quite a lot of equity in the properties, which I've built up over the years, different sort of strategies and stuff through that.
Okay, great. So it really goes to show that regardless of the time in which you invest in, you can always make money as long as you've got the right strategy in place.
Absolutely. And one thing I've learned over the years, and one thing I've devised a lot, is to have a strategy. If you don't have a strategy, then you end up getting lost and you can really stop and nothing happens. So that strategy is really important, but you can make money in any market as long as you have a strategy on how you're actually going to do that.
Yeah, indeed. Okay, cool. All right, well, property number 2. So you weren't able to leverage equity from the first property, so presumably you saved up a second deposit?
Yeah, so during that time, because I was always quite frugal, always good at saving.
Yeah.
A bit of a background to that, before I bought my first property, I'd never bought a new car and I'd never gone overseas.
Yeah, oh wow.
So I didn't, and I'd never had a credit card. In fact, I was probably 36 until I had a credit card.
Yeah,
so
wow. Okay.
so I was quite frugal with that.
Yeah.
And that meant that after my first property, while I did go and treat myself to a bit of a trip overseas, I still saved up for the next few years. Yeah. And then I actually went at 90% LVR for next property, so I just put down a 10%
for the second one,
plus the lender's mortgage insurance.
Okay.
So I actually used like my own funds to actually buy the next property.
Yeah, indeed.
And then lease out the first property.
I see. So you moved your principal place of residence into property number 2, and then the first one was rented out at that stage. And what sort of yield were you getting? I know we're going back quite a while, right?
Yeah. So the yield on it was actually quite good. I was getting about 320 a week in rent at the time. Yeah. Okay. But for a purchase price of 260 when I bought it, so the loan on it was obviously less than that.
Yeah, indeed.
So the rental yield was actually quite good.
Yeah.
In terms of generally you really struggle to make particularly good yields in Sydney.
For sure.
So the yield wasn't too bad on that.
Above 7%. So when you're talking all your general costs like rental management, insurance, etc. Maybe you're breaking even, if not slightly cash flow positive. Yeah,
I'd say more likely breaking even, because you got your rates and all that kind of stuff you got to account for. Probably slightly positive cash flow, but it was a reasonably good position for me to be in, because I could then go and buy my next property, and that helped me with my serviceability. Because at the time I didn't have a big income. I was working as a teacher. So I was trying to build up a portfolio, and then but I managed to get lending for that second property and still keep that first property, and the cash flow from that did help with that serviceability for my next property.
So at this point in time, you were a motivated property investor. Was this the difference between property number 1 and property number 2? Did you start to go through maybe an education process?
I did. So I really started to educate myself.
Yeah.
And then I really started to look at, I started to really want to get ahead, and I thought, okay, as a teacher, I'm going to be on limited income. I'm not going to have much money put away for super, particularly because I hadn't had a full-time job for long, because before that I was a peripatetic music teacher, which basically meant I was just sort of working by the hour, teaching students. So I didn't really have a salary job, so not much money put in super. I didn't want to live off the pension. So I started to think about my future.
What age were you at this realisation?
Well, I was in my early 30s. Yeah. So to some extent I was probably a bit of a late bloomer, because there are people these days which is great who are younger than really thinking about things.
I mean, you see both, right?
Well, you do see both, and there's obviously people that I see a lot of people who are a lot older
for sure.
than what I was, and they still haven't got things quite together. So you're never too late. It's never too early or too late to start. I was in my early 30s, and then it was a mixture, I guess, at the time of wanting to set myself up for finances, but also I didn't see myself as being a teacher forever. So I actually wanted to start setting myself up so that I could actually retire from having that 9-to-5 job, because I didn't want to be someone that would get through to retirement age at 65 and look back and maybe have a whole career at something that I didn't remain passionate about forever, and I could sort of see that passion starting to wear.
So how did you actually educate yourself to realise what is possible? Because until you get into it, right, it's like, I'll have a property and maybe at the age of 60 it'll double in value, triple in value, and then I can sell that asset and I'll have a few $100,000 in your bank. But as you get more immersed into property, you realise actually there's a lot more that I could do.
There's absolutely a lot more to do. Now, and a little bit with trial and error and some mistakes. So my third property, as soon as I bought my second property, I got very excited and I crunched some numbers. And I realised that I spoke to the bank and I could actually buy for another property, but if the property was positively cash flowed.
Okay.
Now I didn't know too much at the time, so I thought, okay, what I want is a positive cash flow property. Now when I look back on that now, I realise that creating wealth through property is done by capital growth. That's what's the most important thing. So whether you're manufacturing that equity or whether the equity comes through the market, that's what's important, not so much the actual cash flow. But at the time I was thinking, I just want a high yielding property, and I thought to myself, if I have lots of high yielding properties, then I'll be able to retire from work.
So that was your income, right?
That was a simple method with that. So I actually enlisted the help of a buyer's agent at the time.
So this is property number 3.
Property number 3.
First time with a buyer's agency, and the brief was, in order to get finance, I need a cash flow positive property.
Yeah, that was part of the brief, and basically I basically said to him, I want a cash flow positive property with as high a yield as you can find, and then I want to keep building my portfolio like that. Now the interesting thing is the buyer's agent went and found me exactly the type of property that I told him I wanted. But looking back on that, it was actually the wrong property. And when I work with people these days, I really look at their strategy and try to educate them. Because what I would have liked to have been told at the time by this buyer's agent was that you should be trying to find something that's going to be in a really good area, that's going to get good capital growth and all that. What my buyer's agent did for me was he found me a high yielding property, but it was in a mining town.
And the plot thickens.
So, and it was in a mining town that at the time was getting about 28% growth.
Oh wow!
So it was so it was huge, and it continued to get growth for a couple of years after that. So I thought I was onto a winner. I thought this is great, and it was it had a yield of about 10.5%. So it was fantastic. However, and of course, in between buying that and a few years later, when I bought some other properties. But a few years later, about the end of 2012, when the mining really slowed down, you could say it probably collapsed, then property values collapsed in those mining towns. And what I obviously learnt through that process is that you should never buy in an area that has only one industry. One horse town, so to speak.
Fair enough.
So that was a lesson learned.
So the intention with that particular property was to retain for long term and always benefit from the cash flow. And of course, you didn't anticipate that the values might drop.
Yes.
And I would imagine that the precursor to the values dropping is a reduction in the rent demand, which meant that your rental yields fell as well.
So my rental yields fell. Now I've still got the property. It's still rented out. It's still part of my portfolio. But it went from an extremely cash flow positive property to a negatively geared property.
Oh wow!
Now
on the purchase price.
Yes. So
do you keep that there as scar tissue, just as a reminder to never make that mistake again?
And I share that with all my clients, all the investors I speak to these days. So I guess what I was wanting, I guess at the time, was a bit of education from the buyer's agent, but he just sort of just bought me what I asked for, which is probably not the right thing. But I certainly learnt from that. But what I also did was I didn't actually keep making that mistake. So although the next few properties I bought won't necessarily in mining towns, because I know some people have maybe got a little bit enthusiastic over the years, and I know of people that bought 10 properties in a mining town, then the industry collapsed and suddenly they're millions and millions in negative equity and they go bankrupt. So people have been into a lot of trouble doing that. I only ever bought that one property in a mining town, but certainly it's something that I advise people never to do. And it was something that I learned from that, because I realised, and that's when I really started to do a lot of research. Speaking to people, contacting successful property investors, listening to podcasts, doing everything I could to really immerse myself and think to myself, okay, at this stage I had 3, even more, maybe 4 properties, because I was starting to acquire some more. And I was thinking, like, I've got a few properties, I'm getting a bit of debt, apart from having one cash flow positive property, they're not fantastic. And I thought there must be a way to do better than this, because there are people that have done really well through property, but I'm kind of just sitting there not doing that great. So I learnt all about cycles and markets, and then about how to add equity to properties and manufacturing growth instead of waiting for that market. And that's when things started to really turn around for me.
Okay, so we've got 3 properties at this point. You've got the mining town one, which was great cash flow. How did you leverage? So it looks as though there was great annual capital growth. Were you able to refinance the mining town property in order to go again? And
I did at the time. Absolutely, So and because it had good equity in it, and it was getting a lot of growth, I was able to refinance that. I also refinanced Rockdale, which over the years I've actually refinanced probably about 4 times. So it's been really good for allowing me to get into other deals. But I bought some more properties, a couple of more properties. So I sort of bought one. I think I bought a property in Newcastle at the time and a property in Toowoomba. But it was when I was up to about 5 properties. When that's when I really sort of educated myself and thought, okay, I'm going to do something a little bit different and do a development. And adding value. And by building a duplex. And subdividing that, and the equity gain I got out of that was something that really changed my life. And basically what happened was that at the time I was earning 70 grand a year as a teacher.
Yeah.
And I built the duplex, I got it subdivided, and then I had 141,000 in equity from it.
So you got 2 years worth of income in that one deal.
In that one deal.
Sorry, was this the one in Toowoomba or Newcastle?
That particular one was in Armadale.
In Armadale,
Yeah.
Okay, yeah, great. So that was 140 grand equity on that one particular deal. And what was the turnaround of that one?
So in terms of how long it took to build, so the build time on that was about 5 months. Yeah. I had quite a lot of issues with council because I didn't really know what I was doing at the time.
Yeah.
So there's a few issues with council and working with the builder, and this is all new to me, but a great learning process for future deals. And future deals that I'd done had made more equity than that, but this one was sort of a starting point. This was sort of a key moment in my career where it sort of doubled my income, and I always remember thinking that was my ha-ha moment. Yeah. And I thought, okay, this is what I need to do, and I need to repeat that process. And that's what I started to do was find deals like that and repeat that process. The council turnaround time was probably about 5 months on that particular one, so it dragged a little bit. And as it turns out, they can vary anywhere between 3 to 5 to 6 months depending. Yeah. But sort of at the time, it was all a little bit unknown to me. But it's just through research and a bit of advice and help and being on forums and listening to podcasts that I got through that. And
okay, cool. So you're really building out a portfolio at this stage. You've got a couple in Sydney, you've got your Manning-town cash flow property, you're building duplexes. So you're starting to take on board a bit of debt, whilst by the sounds of it, intending to consciously manage cash flow at the same time. Did finance at this point ever start to become a bit of an issue?
Not really at that point. Yeah. Now, things have changed a bit over the years. At the time, lending was easier in Australia then than what it is now.
Indeed.
So although I was, I guess as a full-time employed teacher, my salary was sort of increasing a little bit each year. Yeah. So that was quite good. What was also helping was that when I had properties that were positive cash flow, that was also helping serviceability. Yeah. So I was managed to get more deals over the line quite well. So lending wasn't such an issue at that time because I had positive cash flow, I had equity in properties and things like that. But I also started to diversify a little bit. I did a few other things. For example, when I take equity out of a property, excuse me, I would use some of that equity and maybe put a deposit on off the plan apartment or something.
Right. Okay.
I bought a couple of them. Yeah. That's not generally a strategy that I advise on, but for my own portfolio, it's worked a couple of times because what that's meant is that I could secure a property that I believed was going to be good for my long-term portfolio, but not have to get the lending on it right at the moment.
So you put down 10% with the intention that you've got maybe 2 years to save up the next 10% if you're going for an 80% LVR? Yeah,
that's correct. Yeah, so that's part of the reason. And also realising that in a couple of years' time, I might have better lending, better serviceability for lending.
Why might that help your lending?
Because because I felt my income was increasing and my positive cash flow for properties was increasing. Yeah. And I also started to have other strategies where occasionally I'd start to sell a property. So, and that's where duplexes are quite good because you don't need to sell the whole thing. Once you subdivide it, you can just sell one unit.
Indeed.
And one unit can actually then pay down a bit of debt. Yeah. But that also increases the serviceability. So a few clever things like that help with that.
So you kind of went. You saw the real benefit of the duplex strategy. You built one by the sounds of it in Armadale, Newcastle, and Toowoomba. And at this point, were you intending to hold all of them, or did you action what you've just stated in that maybe you needed to sell one or a couple of the sides?
I think originally I was planning to just hold them all, but as time went on, I did have to just sell down occasionally, just to free up a little bit of serviceability. But that's because lending gets a little bit tighter, and the goalposts for lenders change a little bit and things like that as well.
And related to that, did you always work with a mortgage broker, or did you kind of go to the banks directly for a little while? Yeah,
it's interesting. When I first started out, I was working with a mortgage broker. Yeah. And then I started going directly to the bank. Yeah. And that caused...
What was that?
Well, again, that caused a bit of lack of education on my part at the time, because I ended up in a situation that I strongly avoid people not to do, and that's to be cross-collateralized. I actually went to the bank and I fell for their little streak of their little spiel of
put it all with
us, we'll give you a better interest rate. Yeah, absolutely. Yeah. So that's actually what happened. Yeah. And I also fell out with one of the mortgage brokers I was using at the time because he'd set up a couple of loans with me with one particular bank, and then I'd gone straight to the bank for the next one. I didn't really know how that worked. I didn't mean to offend the mortgage broker. It's all part of the learning process.
For sure.
And that didn't, at the time it didn't matter too much to me because I had pretty good equity and pretty good lending, and when I did that, I was only sort of tying about 3 properties together. If you have 10 properties and they're all tied together, then you're in big trouble, obviously, because if values go down or the bank's trying to reclaim something, or you want to sell a property, they've got to get everything else valued before they sell it. So that can be quite tricky. That was just something I did. But from that, after that, I have used mortgage brokers ever since. Yeah. It's something I do advocate, because a good mortgage broker will find you, the best loan for your scenario. Realizing that you need to find a mortgage broker that thinks about your long-term strategy. It's not just one property. They need to think about what your overall plan is. Indeed. Because you need to buy a property, realizing that you need to be able to buy a property after that. So what does your next property going to look like? How are you going to fund the next property? And that's something that I regularly talk with my clients and their brokers about, to make sure that we're all on the same page about a long-term plan for that.
Yeah, for sure. I mean, if I look back on my journey in property, when I first started, I always just assumed that lending is unlimited, and then I can just buy and buy and buy. And if I created equity during the process, then that's fine. Then I can purchase another property, I can purchase number 2, 3, 4, 5. But it's only actually from going through the process, which sounds quite similar to yourself, that you realise, you know what, money is not limitless from the bank.
Absolutely.
And as a result, I've probably gone through 4 or 5 different mortgage brokers, because to an extent, as an investor, your potential is limited by the mortgage broker and the team that you work with. So if they're maybe not working with investors that have 10, 15, 20 properties themselves, then of course their knowledge will be limited in itself.
Yeah, and that's something I've learned a lot throughout the years as well, is that there are mortgage brokers who are really experienced and know exactly what to do. And then there's ones that, you're writing a loan and getting a loan over the line for one property is completely different to trying to build up a portfolio. And also things like construction loans. Not all banks do construction loans. I've had clients who've had brokers who've, done a construction loan with the wrong bank. Maybe the client wanted to go at 90% LVR for a construction loan. The broker just put them with a particular bank, and their policy was only 70%, but the broker didn't know, and that kind of stuff. And it really and in some cases the clients almost missed out on the deal because they were, really late exchanging contracts or getting the finance through and things like that. Because the finance was messed up. So you really need someone who's really on board from the start and knows exactly what what you're trying to achieve with that sort of thing.
So it looks as though you've gone through quite a few strategies. You've educated yourself. You've gone through the school of hard knocks. You've made the mistakes, and that bit of scar tissue has put you in a really good position, because exactly. You've kind of refined your strategy by the sounds of things down the line, and progressing your own knowledge, which means that you can now pass that on to your clients as well, whom you work with. So what's the next steps then for yourself? So you've got 16 properties. You've got quite a significant value to that. You've got a very conservative, I would say, in my personal opinion, LVR. What does the next 5, 10, 15 years look like for yourself in your personal investing journey? Yeah,
well, I guess last year, my wife and I achieved a real, a real goal, and that was, I guess, a couple of goals. But one was we bought our dream home last year.
Fantastic.
We had a couple of homes before that, and we were just sort of working up to that. And one of the things that I work with sort of everybody on is, if one of your goals is to get your dream home, this is what we need to work towards. So that's something I've done. Of course, the other one was we had a baby this year. So
congratulations. That's great. I thought you had bags something.
All totally fair. So that's one sort of goal that's kind of achieved from that perspective. So with my portfolio, I'm wanting to diversify a little bit more and get into probably some commercial property and stuff, because that's something I haven't done up to now.
Yeah.
Now, what I've really done, I've got a good asset base of residential properties, which is really important, and I think that's what you really need to have before you get into commercial properties. Commercial properties, obviously, they have higher yields, so they're attractive for cash flow. They have long-term tenancies in place, which a lot of people find attractive. What I've always found with them also is that if a tenant does move out, it can be hard to find another tenant. So you need to be prepared for that little bit of risk. So you need to have a good asset base and good cash flow to be able to manage that. And I'm in a position now that if I wanted to be a little bit more risky and take on those kind of properties, I'd be able to sort of do that. But I'm also at the moment sort of evaluating where my portfolio is after the recent property cycles and into the next one. I'm looking at probably selling down a couple of properties and then taking some of that cash and investing elsewhere and things like that as well.
So is that how you'd redistribute the funds into commercial specifically, or are you keeping kind of this separate to commercial? So you've got your base portfolio, maybe then you move into high cash flow stuff like commercial. Yeah,
so it's a little bit of both. I'll be probably selling a couple of the residential properties and using that cash to go into some commercial properties and things like that.
Okay.
So that's that's sort of part of it. But essentially, keeping that LVR sort of quite low and conservative. I mean, it wasn't always conservative. I used to buy properties. I've never been scared of lenders' mortgage insurance. So I used to buy at 90%.
And is that kind of how you've been able to achieve such great kind of portfolio?
I've always thought that if you've got like enough deposit for 20%, then you should just buy 2 properties for 10% each. Then you can buy more property. That was always my philosophy. So it's been a little bit more savvy about things, I guess.
Indeed.
I'm not scared of using LMI. It's something that you can capitalise anyway. So if you sell the property, you can,
So why is it now that your LVI is so low? Did you kind of feel as though, okay, I've got enough? So there's no point to go to continue to be so aggressive?
So there comes a time, I think there's 3 stages in a portfolio, and there's the acquisition phase, and then there's the holding phase, and then there's, I guess, the exit strategy. So I'm not really at an exit strategy yet with my properties or anything, but I am at that stage where I don't need to be so... things are sort of consolidating now, and I don't need to be in such a hurry to be buying more properties, because I think financially things are good. I've got a good asset base of properties, and of course I've got the business now, which is something that I'm really concentrating on and helping other people emulate what I've done. So I'm not in such a hurry to, I don't need to be one of these people who have 40, 50, 60 properties, and it also I don't think a number is really what you need. I think it's more about the value of the properties and the quality of them and how they can help you. And as long as they're achieving your goals, then you don't need to be just buying more and more properties just for the sake of it. So it's more about consolidating things now and starting to maybe sell a couple and that'll I guess one of the things about selling a couple of the residential properties might also to be pay off some more of the owner-occupied debt, because obviously with our house we've got a little bit of debt on that. I have in the past actually. Our last house, I'd paid that one off, which I'd paid off through equity in properties that I'd created. And then I used that, and that home, which is in Lewisham in Sydney, I sold that to help fund our new house that we bought last year.
With a significantly larger deposit.
So I had a significantly larger deposit. So that means our PPOR has it's a very conservative LVR on it. But it's quite an expensive house as well. So it still does have significant debt. And that's something I'll be obviously looking to pay down as quick as possible. So that's all part of that strategy there.
So you mentioned a big part of what you do now is the business. And we've also discussed off camera that you're currently in the process of writing your first book.
I am indeed.
So tell us about that. Is that kind of sharing your journey and your perspective on property investing?
It actually is. It's going to be sharing the journey of my whole life. So going back from a little bit from when I was growing up, when I went to uni and studied music, a bit about my professional music career and teaching career, even a bit about when I was an avid golfer, all that kind of stuff. And then basically getting onto my property journey and just sharing my whole journey, and I guess the mistakes I've made, why things didn't take off for me for the first 5 years, and then how I managed to then build up a large portfolio and the type of strategies that I've used. And I go into a lot of detail talking about finances, the need to have good mortgage broker on your side and all that. Different strategies, and different strategies not just the duplex strategy, but other ones I've used are things like, renovating properties, buying properties off market, under market value, give them a bit of a TLC and how you can actually add some value and build some equity quickly through a bit of a renovation that may only take you, 2 or 3 weeks and that kind of stuff. So all that kind of stuff, and we just share with everybody my journey through the book and how I basically help my clients these days to try to achieve their goals. But I think what it's all about is property is a vehicle. Yeah. So some people will use property, some people might use shares or stock market and whatever.
Indeed.
But it's just a vehicle. So everyone needs to have that goal. And one of the chapters in my book will be about goal setting and then how to achieve those goals through strategy. So people need to know really what they're looking to achieve, whether it's 10, 15 years down the track. And then we look at that goal, and that goal could be owning your dream home, could be retirement, could be having one parent living at home looking after the kids and the other parent at work, so sort of don't have to be both working parents. Or could be being able to afford to put your kids through private schools. There's all sorts of different goals for people.
And then presumably you reverse engineer it.
Yeah, so exactly. So it's all reverse engineering, and then we look at how we can actually get there. Yeah. But generally not through just buying properties and just hoping and praying for the best. So it's about strategies and how you can actually
taking control.
Yeah, take control. So it's not about like if you want to have a certain goal achieved in 10 years, and that might be you might want to have 100k passive income, for example. Yeah. Then you're just buying properties and just waiting for a bit of growth isn't really going to just achieve that. People might set out that way and think they can do that, but you really need to be a bit more savvy and have strategies in place how you can get equity from a duplex development, from even a subdivision, maybe getting a block of land into a 1 into 3 subdivision, or buying a block of land that has a house on it, subdividing that, building behind it, and then turning one property into 3 properties because you've just built maybe a duplex behind the house. There's so many strategies that you can actually create equity on.
Sounds like quite a big book.
Depending on the council requirements, you might need 1,000 litres or something block to do something like that.
So when's the scheduled release date for the book?
So not confirmed yet, but hopefully later this year. So stay tuned.
Okay, so is it going to be in time for Christmas?
Hopefully it'll be in time for Christmas for people to have a little bit of a Christmas stocking there.
Well, my wife is going to have a nice Christmas there. Well, if people do want to get in contact with you, Lloyd, what can they do? How can they reach out to you?
I encourage people to visit my website, which is ozpropertyprofessionals.com.au. The phone number is 1800 146837.
Well remembered.
Yeah. It's hard to remember the 1800 number. I also have a Facebook group, or a couple of Facebook groups. So there's the Oz Property Professionals Facebook group, but there's also a group called Basecamp Property Club.
I know it. I'm a member.
And that's fantastic. Yeah. And that's all about education. So we don't try to sell anything in there. I post videos in there. I get other people to contribute, get brokers to contribute and stuff like that. And that's all about educating people. Because quite often, and the reason it was set up like that was there's people who aren't ready to maybe invest just at the moment, but they want to get some education, get some confidence behind that. So it's about taking people from like a base camp and then trying to get them up to the pinnacle of Everest, or pinnacle of the mountain through different stages of investing. So that's all about education there. Hopefully people can learn and take something from that and just be part of that group. So that's great, and so there's plenty of opportunities there for people to reach out, and social media like that is really great because people can start conversations, and if they've got questions, we can just answer their question and stuff like that without the need for them to necessarily pick up the phone if they're not quite ready to buy a property or whatever. Indeed. But I also offer free strategy sessions, so people can get in contact with me if they just want to discuss their portfolio or discuss starting a portfolio, and maybe we can talk about their goals and how we might be able to help them and see if we're the right fit for what people are trying to achieve.
Lovely stuff. All right, well, thank you so much for your time today, Lloyd.
My pleasure, Ryan. No problems at all. Thanks very much.
Thank you.